Jake hands his money to a professional with a research team, a Bloomberg terminal, and 20 years of market experience. Marcus hands his money to a machine. They both invest the same amount, on the same day, for the same 20 years. And when you run the actual numbers at the end, the machine wins by $187,000. Not because Marcus got lucky, not because Jake picked the wrong advisor, because the math was never fair to begin with. And by the end of this video, you'll know exactly how much professional management has cost you in real dollars, and where that money actually went. Let's keep this fair. Jake and Marcus are both 35 years old. They both just got serious about investing. They both have $10,000 saved, and they both commit to putting $300 a month into their investment account for the next 20 years without touching it. Same starting point, same discipline, same time horizon. The only difference is where the money goes. Jake's coworker mentions his financial advisor. The advisor works for a well-known firm. He has a clean office, a confident handshake, and a brochure full of performance charts. He puts Jake into an actively managed large-cap U.S. equity fund. The fund has a team of analysts monitoring hundreds of stocks. They move in and out of positions based on research. They claim to identify opportunities the market hasn't priced in yet. The expense ratio is 1%. Jake doesn't think much about that number. 1% sounds like almost nothing. Marcus opens a Fidelity account on a Tuesday night. He reads an article. He puts everything into a total stock market index fund with an expense ratio of 0.03%. No advisor, no research team, no phone calls, no brochure. He sets up the automatic $300 monthly contribution and closes his laptop. His friends ask him what he's investing in. He says index funds. They nod and change the subject. Nobody is impressed. On day one, Jake feels like he's in good hands. Marcus feels like he did nothing special. And for the first few years, that feeling is exactly what Jake's advisor is counting on. Before we get into the math, let's make the strongest case we can for Jake's choice. Because if we don't take active management seriously, we're not being honest about why 50 million Americans are in actively managed funds right now. The core promise of active management is this. Markets aren't perfectly efficient. There are moments when stocks are mispriced. A professional with the right tools and the right data can spot those mispricings, buy low, sell high, and deliver returns that beat a passive index. That's not a crazy idea. It's actually a reasonable hypothesis, and in certain years, certain managers do exactly that. There's also the protection argument. An index fund owns everything. When the market crashes, it crashes with the market. An active manager can move to cash. They can rotate into defensive sectors. They can reduce exposure before the storm hits. In theory, they can protect you on the way down in a way a passive fund cannot. And then there's the relationship. Jake has someone he can call. Someone who knows his situation, his retirement timeline, his risk tolerance. When the market drops 30% in a month, Jake's advisor talks him off the ledge. That has real value. That's not nothing. These are the reasons Jake's choice feels smart. These are the reasons the active management industry manages roughly $14 trillion in U.S. assets. The pitch is coherent. The logic is sound. The problem is the math. Here is the number your advisor will never lead with. The expense ratio. Jake's fund charges 1% per year. Marcus's fund charges 0.03% per year. The difference is 0.97%. That sounds like noise. Over 20 years, it is anything but. Here's why. The expense ratio isn't charged on your gains. It's charged on your entire balance, every single year. And because your balance grows through compounding, the fee grows with it. You're not paying 0.97% of your original investment every year. You're paying 0.1% of an ever-growing pile of money every single year. For 20 years, let's run the numbers. Jake and Marcus both start with $10,000 and contribute $300 a month. The broad U.S. stock market has returned approximately 10% per year on average over long historical periods. We'll use that as the gross return for both, before fees, to isolate the cost of the expense ratio. Marcus's index fund at 0.03% delivers an effective net return of roughly 9.97%. After 20 years, his portfolio is worth approximately $256,000. Jake's actively managed fund at 1% delivers an effective net return of roughly 9%. After 20 years, his portfolio is worth approximately $213,000. The difference is $43,000 from one number. 1% compounded over 20 years on the same gross return. Jake paid $43,000 for professional management before we account for a single thing the manager actually did differently. But 1% is just the number on the brochure. Let's talk about the number that isn't. Most investors look at the expense ratio and think that's the full cost. It isn't. It's the advertised cost. The real cost of owning an actively managed fund has several layers that rarely appear in the same conversation. The first layer is the load. Many actively managed funds charge a sales commission called a load. A front-end load is taken off the top when you invest. A common front-end load is 5.75%. That means Jake's $10,000 initial investment actually puts $9,325 to work on day one. The other $575 goes directly to the distribution channel before a single dollar is invested. Over 20 years at 9% net return, that missing $575 compounds into approximately $3,200 Jake never had a chance to earn. The second layer is the 12B1 fee. This is a marketing fee buried inside many actively managed funds. It's used to pay for the fund's own advertising and to compensate the advisors who recommend it. It ranges from 0.25% to 1% annually. It's included in the stated expense ratio, but most investors don't know it exists or what it's paying for. Your fund's fee is partly covering the cost of convincing other people to buy the same fund. The third layer is transaction costs. Active managers trade. That's the whole point. Every trade inside the fund generates brokerage commissions and bid-ask spreads that don't show up in the expense ratio. Research estimates these hidden trading costs add somewhere between 0.5% and 1.5% per year to the true cost of owning an actively managed fund, depending on how frequently the manager turns over the portfolio. The fourth layer is cash drag. Active managers hold cash. They hold it to buy opportunities, to manage redemptions, to time entries. But cash sitting on the sidelines earns nothing while the market is moving. The average actively managed equity fund holds 3% to 5% of its assets in cash at any given time. In a year, the market returns 10%. That cash position cost the fund 0.3% to 0.5% in foregone returns. Add it all together. The stated expense ratio of 1%. Front-end load, amortized over the holding period, hidden trading costs, cash drag. The true all-in cost of Jake's actively managed fund is likely somewhere between 2% and 3% per year. Not 1%. Let's rerun the numbers with a more realistic 2% total cost. Jake's net return drops to approximately 8% per year. After 20 years, his portfolio is worth approximately $185,000. Marcus is still at $256,000. The gap is now $71,000, nearly 3 times what the expense ratio alone suggested. And we still haven't talked about whether the active manager actually beat the market. This is the part Jake's advisor would rather skip. Let's not. Every year, S&P Global publishes a report called the SPIVA scorecard. SPIVA stands for S&P Indices versus Active. It compares the performance of actively managed funds against their benchmark index across every major category. The data goes back over 20 years. It is the most comprehensive performance comparison in the industry, and the numbers are brutal. Over a 20-year period, approximately 90% of actively managed large-cap U.S. equity funds underperform the S&P 500 after fees. Not 50%, not 60%, 9 out of 10. Over 2 decades of professional management, research teams, Bloomberg terminals, and market expertise, 9 out of 10 funds failed to beat the index a passive investor was tracking automatically for 0.03%. A year. Jake's advisor is statistically more likely to be in the losing 90% than the winning 10%. And even if he's in the winning 10%, you have no reliable way to identify that in advance. Because past outperformance in active management does not predict future outperformance. The academic literature on this is consistent and has been consistent for decades. But here's the part of the SPIVA data that most people never see. The survivorship bias problem. When SPIVA calculates how many active funds underperformed, they have to decide which funds to include. And there's a quiet problem buried in that decision. Funds that fail get closed or merged into other funds. They disappear from the database. The funds you can compare today are the ones that survived. The ones that didn't survive are simply gone. This means the 90% underperformance figure is likely understating the problem. The real number includes all the funds that were shut down because their performance was too embarrassing to continue. The graveyard of failed active funds is enormous and largely invisible. The survivors look better than the full picture actually is. When you account for survivorship bias, the case for active management gets even weaker than the already damning headline number. There is one more cost that never appears on a fund's fact sheet. It is called the behavior gap. And for Jake, it might be the most expensive cost of all. Active funds are sold on the premise that management decisions add value. When the manager makes a change, there's usually a communication about it. A quarterly letter, a market update, a call from the advisor. Each of these communications is an invitation for Jake to react, to question, to make a decision. And every decision Jake makes about his investments is an opportunity to make the wrong one. Research from Dalbar, which tracks investor behavior over long periods, consistently shows that the average investor in an actively managed equity fund earns significantly less than the fund itself earns. In their most recent studies, the gap between fund return and investor return has been as wide as 1.5% to 3% per year. The reason is behavior. Investors chase performance. They buy after a strong year and sell after a bad one. They react to market headlines. They listen to their advisor make changes and second-guess those changes. Every time Jake switches funds based on a recommendation, there's a potential tax event in a taxable account. Every short-term capital gain is taxed as ordinary income. Every switch resets the clock on long-term capital gain treatment. The transaction itself has a cost. The tax event has a cost, and the psychological churn of constantly evaluating whether to stay or go has a cost that never shows up in a whole dollar figure but shows up in every suboptimal decision it produces. Marcus never switched. Marcus never reacted. He didn't get a quarterly letter. He didn't have an advisor calling him when the market dropped. He just watched the number go down, and then back up, and then higher. The inaction was the strategy, and the inaction compounded. Here's the 20-year scoreboard in full. Marcus invested $10,000 upfront and $300 a month for 20 years. Total contributions, $82,000. Portfolio. Value at year 20, using a 9.97%. Net return, approximately $256,000. Total fees paid to. Fidelity over 20 years, approximately $430. Jake invested $10,000 upfront and $300 a month for 20 years. Total contributions, $82,000. Portfolio. Value at year 20, using an 8% net return after realistic total costs. Approximately $185,000. Total fees and costs paid over 20 years. Somewhere between $40,000 and $60,000, depending on load structure, trading activity, and advisor compensation. The machine beat the professional by approximately $71,000 to $87,000 on the same contributions. Over the same time period, in the same market, the only variable was cost. Now let's be honest about where active management does have a legitimate case. Because if we only showed you the downside, we'd be doing the same thing we're accusing the industry of. There are specific asset classes where active management has shown more consistent value over time. Emerging market equities are less efficiently priced than US large-cap stocks. There's more room for a skilled analyst to find mispriced opportunities when markets are thinner and information is less evenly distributed. Certain fixed income categories, particularly high-yield bonds and distressed debt, also show more consistent evidence of active manager skill. Small-cap value investing in certain cycles has produced active managers with genuine long-term track records. The case against active management is strongest in US large-cap equities, the most efficient, most analyzed, most competitive market on Earth. It gets somewhat weaker as you move into less liquid, less covered corners of the market, and the advisor relationship itself has real value that the fund performance debate often obscures. A good advisor who keeps Jake from panic selling in March 2020 might save him more than the fee costs. A good advisor who builds a tax strategy, coordinates estate planning, and helps Jake think through Social Security timing is delivering value that has nothing to do with which fund they put him in. The critique is not that advisors are worthless. The critique is that the specific product they often sell, the actively managed fund, is where the math breaks down. So, here's what to do with this information. It takes about 60 seconds. Pull up any fund you currently own. Go to the fund's fact sheet, or look it up on Morningstar. Find 3 numbers. First, the net expense ratio. Anything above 0.5% deserves scrutiny. Anything above 1% is expensive by any modern standard. Second, the portfolio turnover rate. This tells you how frequently the manager is trading inside the fund. High turnover means high hidden transaction costs. A turnover rate above 50% and a yellow flag. Above 100% means the manager replaced the entire portfolio at least once last year. Third, the 20-year annualized return versus the fund's benchmark index. Not the 1-year return, not the 3-year return, the 20-year return after fees. Compared to the index, it's supposed to be beating. If it's below the benchmark over 20 years, you now know exactly what that has cost you. Jake and Marcus both got serious about investing on the same day. They both stayed disciplined for 20 years. They both did everything right by the rules they were taught. The difference is that Marcus read the number nobody told him to look at. He found 0.03% and understood what that meant over time. Jake trusted the professional and paid for that trust in a way that never appeared on a single statement. The machine didn't win because it was smarter. It won because it was cheaper. And cheaper, compounded over 20 years, is worth more than almost any investment decision you will ever make. The single most powerful thing you can do for your long-term returns is not finding the right stock, not timing the right market, not hiring the right advisor. It's minimizing what you pay to play. Because every dollar in fees is a dollar that never compounds. And a dollar that never compounds today is worth $6 at the end of 20 years. If you want to run these numbers on your own portfolio, find out exactly what your current expense ratio is, actually costing you over your remaining investment horizon. I built a calculator that does it in under 2 minutes. It's inside the Wealth Logician's vault alongside every other tool we've built for the channel. Becoming a member gets you the full vault and a community of people who are actually doing the math. If that sounds useful, the link is in the description. Hit like if this changed how you see your portfolio. Subscribe if you want to do the math on the next one. And I'll see you in the next one.